Hi, this is John Hollahan, and I'll be presenting the Arlington Wealth Management Market and Economic Insights for Friday, July 29th. Well, so far it's been a pretty eventful year in equity markets. Most of the major indices made new highs either late last year or literally in the very first week of January of this year. Our models entered the year in defensive mode. We had raised cash based on tactical high-risk periods that we identified the previous year. And then our model went to full capital preservation mode in April when we received a global sell signal. And then significantly, 2 weeks ago in the report, Joe mentioned that we had received basically a capitulation signal or some level of capitulation that we had identified in the market. And we view that as a low-risk tactical buying opportunity. We view the signal as an opportunity to partially, and I emphasize partially, deploy cash that had been raised previously, as a significant amount of risk has likely been shaken out of markets. So with that background, I'd like to kind of bring us forward. What's happened with our models since that signal, what we've seen on the economic front, what we've seen on the monetary front recently as well, and kind of share our thoughts on how we think things could progress from here. So let's start by checking in on our dashboard. And you can see a whole lot of red still here, indicating that the major market cycle we're still identifying as bearish. That tactical buy signal that we talked about, and that was July 14th, the day before the video that you saw last from us. And so that represents that selling climax signal, or that, some level of capitulation identified by our indicators. And so if you look at our core indicators, everything is still red, supporting a bearish overall cycle. And our tactical indicators have risen up to the neutral zone, and we'll examine that. But I'd like to have our first chart be a display of our overbought, oversold indicator, where we could see some of that very recent market activity. So here with our overbought, oversold indicator, what I've done is turned on the signal display. So April 22nd of this year was our global sell signal. That's the time when we quickly moved to full capital preservation mode. And that's kind of our tornado warning siren, if you will. We don't know for sure if a bear market's going to hit, but there's enough risk, as indicated by our core indicators, that it's not a great time to be trying to grow wealth, and getting defensive and shifting to capital preservation mode, in our viewpoint, is warranted. So that's what we did pretty quickly at that signal. And you see, as things progressed, a couple of moves down, ultimately to a low here in June, and then a slow rise up, and then kind of this retest right here. And it was at that low, again, not a new year-to-date low, but that retest low, where we identify it here as the selling climax signal, also known as that tactical buy signal. That's when that triggered. And I'll show you in a little bit here the main driver of that signal. But suffice it to say, it told us there was likely a decent level of capitulation, and that it was a good time to deploy some of the cash that we've built up. Now, how much of the cash we build up, there are a few factors that go into that. One of them is our economic outlook. If we don't necessarily see that recession is on the horizon, that would make us want to be a little bit more aggressive and go perhaps as high as deploying half of the cash in the model. However, when economic signals are mixed, as they are right now through our interpretation, we decided to go a little bit more cautious. We only went roughly half of that level of what we otherwise would have gone had we believed that there was low risk of recession. We also look at a series of sub-indicators. Each of them is a measure of capitulation in their own right. And depending on how many of those are telling us that particular indicator has reached the capitulation level, that will influence how much cash we deploy. And at the time of the signal here, 6 of our 12 sub-indicators confirmed capitulation had occurred. And then we actually had one more confirmed capitulation since that signal. So at this point, we've got 7 out of 12 have told us that was likely a point of capitulation. That also means 5 of the 12 are not saying there was capitulation. So we're getting a little bit of mixed signals here. The main driver of the signal clearly reached low risk, and I'll show you that shortly, but a number of the sub-indicators have not confirmed that capitulation yet. So moving back to a partially invested position, in our viewpoint, may be a temporary thing. It all depends on the economic front. Again, you've heard us talk about this time and time again, about the importance of understanding if recession is likely during a bear market, in which case we could expect a longer and more drawn out bear market, or if recession is not happening during a bear market, then the resolution to that bear market is more likely to be shorter and shallower in terms of the ultimate pullback, and a quicker rebound to new market highs. So with a lot of uncertainty with our economic model, we believe there is a chance of another move down in this market, and there's other factors at play as well. Certainly we've talked in the past about we are in a seasonally weak period of the year, and there are the midterm election trends that Joe pointed out last week, that we tend to see the worst periods in the second year, quarter 2 and quarter 3, which is the period we're in right now. That would end at the end of September. And then the 2 quarters following that, the quarter beginning October 1st through March 31st of next year, tend to be the best performing 2 quarters during the presidential cycle historically. So there's a lot of reasons to be cautious right now. We'll certainly keep a close eye on the economic model for indications of possibly slipping into recession. And of course, ultimately, our model is designed to give us the all clear when a global buy signal triggers. We're not going to try and predict when that may occur in the model next, but that certainly is a higher confidence time to deploy capital in our point of view. And what is the main driver of the selling climax signal or that capitulation signal? Well, it's this chart right here, the percentage of stocks that on their 210-day average price have a rising pattern. So in other words, it's a positively sloped 210-day moving average, if you will. Historically, when we see this fall to low risk, it tends to be good opportunities to deploy cash, in that a lot of the weaker hands are getting shaken out at that real volatile point in the market after they've been experiencing drawdowns in their portfolios, and they finally throw up their hands and say, I'm going all to cash. Well, those kind of weak hands, if you will, getting shaken out can often signal a market bottom of, if not moderate term importance, at least a short term importance. And you can kind of see a number of periods here in recent years, late 2015 into early 2016. Took a little time to put in a little base here, but eventually a number of stocks began to shift to those positively sloped trend lines and began to move up. Late 2018 was a period of heavy volatility, and you see kind of a quick reversal here in this chart into early January, and then kind of moving upward nicely with follow-through. This is the COVID shakeout, the pullback associated with the shutdowns. Very swift move down and then move back up. And then eventually that kicked off a nice trend. And now, after rising up to high risk and spending some time up there, you see that it's been on a decline since early 2021. And now more recently has accelerated here in 2022. So in the report 2 weeks ago, we saw the entry hit low risk. That 7 represents a July entry, and hitting low risk here was the main trigger for the selling climax signal. Now the market has bounced a little bit since then, as we saw in the earlier chart, and so this indicator has reversed up. We'll keep a close eye on this one to see if there is follow-through, but we're not going to make a call on that. There could always be a reversal back down, and it could even spend more time in low risk. Now again, this is a very long-term chart. This is based on a 210-day moving average, and that's about a 10-month average price for stocks. Now back at our dashboard, as far as the core indicators go, there hasn't been a lot of movement with this recent bounce in the market, but we did have one reversal to the upside in one of the charts on the cash comparison. So let's take a look at that. And here with our cash comparison charts, the change that we observed here is on the rate of change chart, so it's a little bit faster moving than the relative strength version of the chart over here. You'll notice this is still in a descending column of O's. Here we've got a 3-box reversal to the upside. Nothing to write home about yet. Certainly need to see a lot more follow through here, and as well as a reversal on the relative strength chart to begin to sense that a trend reversal to the upside might be happening with the overall market. But it's one of the green shoots, and we'll certainly keep an eye on this one. Let's check in on our short-term indicators, our tactical indicators. We'll start with the 10-week. It's at 58%, so it has risen up into the neutral zone. Let's take a look. So this is another universe chart. So this chart's the number of stocks in our global universe of stocks that are currently priced above their 10-week average price. So it's another breadth indicator. Tells us if there are a lot of stocks participating in a rally, or if the rally is building momentum by more stocks participating. You see the strong move down here in June, kind of that failed rally attempt that pushed us back to low risk for, looks like, the third time this year. A little bit of back and forth, but now it's gained some momentum to the upside, and you see that it's pushed to where greater than half of the stocks are now priced above their 10-week average price. So at 58%, that means 58 out of 100 stocks, as judged by this indicator, are headed in the right direction, moving above their 10-week average price. Now, because of this tentative situation that we find ourselves in, with conflicting information about the market trend and about our economic model and risk of recession, we're going to try to play this very tactically. If we rise up to high risk here, we might consider taking some money off the table here, raising cash in models. That is a possibility. It'll be, as they say, a game day call. We'll have to see what everything else is telling us at that time. And again, this is a short-term indicator. Nothing, and we really don't infer anything from here about the longer-term trend. And now let's just real quickly toggle back to the overbought, oversold indicator. We saw this earlier, but we really didn't spend any time discussing what the bands were here for and what they're telling us. That's the bear trend average, the line in the middle. That's pretty much where we would expect the index to trade during a bear cycle. We do that calculation, and then we draw high-risk bands and low-risk bands. So you see where the All Country World Index touched low risk back here in June and quickly bounced from there. You see our tactical buy signal here, or our selling climax signal, and now the move up. So, think of it this way: short-term low risk down here, short-term high risk up here. If we continue to see the index move up towards high risk, again, with some of the uncertainty, there is a possibility that we would be taking some of the money off the table and shifting more towards a capital preservation mode. Again, too early to predict. There's just a lot of data to digest as we maneuver through this period of uncertainty. Now I'd like to shift gears and talk a little bit about government policy and action and how that's contributed to the current state of affairs, shall we say. And so for starters, this is a chart of the M2 money supply. This is a 5-year chart. And just to level set here, if we zero in on the area right here, 2018, 2019, early 2020, there had been a kind of a slow acceleration in money supply. And then you see, I'll call it the knee of the curve here. That's associated with all of the actions trying to deal with the shutdowns from early 2020. So you see money supply ramp up quickly, continue to accelerate, and now as we enter 2022, begins to flatten out. But a lot of this increase in money supply is what helped drove up equity prices, in our opinion. And it's also driven up the inflation rate, which we'll talk about in just a moment. But this is this kind of explains a little bit about how, markets reach those all-time highs in, late last year and literally the very first week of January of this year. And that leads us to the chart of the Consumer Price Index year over year. You can see how there was a drop in prices associated with the shutdowns early in 2020, and then a strong move up, again, coincident with the increase in the money supply. And oh, by the way, I won't take the time to show the chart today, but the Fed purchasing assets, increasing its balance sheet to new high after new high after new high, and only recently have they begun to forego new asset purchases and try to begin to taper off that balance sheet. There's nothing material that's been done so far except stopping it from increasing. And so with all that money being pumped into the economy through policy, you see this just a real strong move up in the inflation rate to now we're at a 9% annualized rate for June. Now that brings into focus the Federal Reserve and their role in trying to control inflation. And so some of the actions that they've taken, we'll cover that momentarily. But their main tool, of course, is not only the balance sheet, but short-term interest rates they have some control over. And so they kind of have a fine balancing act of try to control inflation without crashing the economy. Now, last week, Joe alluded to some things that were going on with prices, and let me shift gears. I want to show a commodity price chart here. So here's a chart of the price of copper. It's a per pound price. And on this chart, you can see how coming off of the period of the shutdowns and the increase in money supply, you can see a real steep run up here into early 2021, kind of a sideways move, new high in copper back here in March of this year, and then a pretty strong correction down. And this is what Joe alluded to last week. Maybe even though the inflation rate is up at that 9% level, some of the underlying prices for commodities, and we'll highlight this week, copper, have actually pulled back recently. So the question becomes, if this is a predictor of future inflation rates, maybe things aren't as bad as people think, or maybe this is the beginning of the price correction. The actions of the Fed thus far with increasing interest rates, kind of flattening out their balance sheet, and just other market forces, maybe this is a sign that inflation could potentially be moderating, and that would certainly be an influence on the Fed's future actions. And so what has the macro effect been on the U.S. economy of those policy actions? Well, here's GDP quarter over quarter. So this is what people look at in terms of the productivity of the economy. This is a 5-year chart, and you see a pretty steep drop associated with the shutdowns, and then a pretty quick move back up in terms of productivity as the economy reopened, and then more of a leveling off. And now recently we've got 2 quarters of negative GDP. So in other words, not growth, but contraction. Quarter 1 was measured at a negative 1.60% growth rate. And then this week, this is a preliminary number that's very likely going to be revised. For quarter 2, a negative 0.90 reading. So we'll leave it to the academics as to whether or not we're in a recession, and it probably won't even be till further down the road that we hear of it, if it indeed it is determined to be this. But, by the traditional definition, 2 negative quarters of GDP, a lot of people would call it a recession. Again, albeit somewhat mild, just based on these levels of just dipping below zero. But again, we'll leave it to the academics to make that actual call. Certainly there are some things that are going well in the economy. For instance, employment seems to be staying pretty strong through all of this. So now let's look at the primary tool of the Fed, or one of the primary tools of the Fed, and that's the Fed fund rate. That's the Fed funds rate target. And you could see this is a 10-year chart, and rates were quickly lowered here. Actually, rates had already begun to drop in 2019, and then they quickly dropped with the shutdowns associated with COVID down to a target of between 0.25%, and they remained low for quite a bit. And now in 2022, the Fed has made 4 rate hikes. The last 2 were 0.75% each. So, that's a really steep move very quickly. Again, with the goal of trying to tame inflation without crashing the economy, and the goal being to engineer the so-called soft landing. But that's easier said than done, of course. One of the things Joe talked about in the last report was one of the things that could relieve some of the downward pressure on stock prices, and that would be if the Fed, for some reason, stopped raising interest rates. So this week, as you may have seen, the Fed announced the 0.75% rate hike, and equity markets responded very strongly. So markets have rallied into the end of the week here. So why, with the rate increase by the Fed of 0.75 point, which is a pretty big move, why are equity markets rallying? Well, it all is in the interpretation of the statement. And during the press conference, the chairman of the Fed, Jerome Powell, acknowledged that the Fed has front-loaded the rate hiking cycle. And going forward, the Fed's going to be much more data dependent. So I think the way markets are interpreting that is to say, hey, we've done a lot so far, and, we don't necessarily have to do a lot going forward. I think that's the interpretation. Time will, of course, tell. But the markets are considering, possibility of slowing down anticipated rate hikes, possibly even pausing rate hikes. But as Chairman Powell said, it's all going to be data dependent. So no predictions here on the direction of interest rates. We're simply going to observe, monitor our indicators, and that would include, of course, our economic model, which is going to be key in this, as well as our evaluation model, which we have shown in previous reports had reached some extreme levels. So to wrap things up, 2 weeks ago, our strategy triggered a tactical buy signal, also known as a selling climax signal in this context, and it tells us that it's a potentially low-risk time to deploy some of the cash that was built up. And so we did deploy cash and got it invested. The models still hold a significant amount of cash, and in fact, more cash is held than long equities are held in models right now. Part of the strategy calls for analysis on the economic front to determine if we believe that the economy may be headed into recession or not. And with some unclear indications on that front, we didn't deploy as much cash as we would have had the economic picture been rosier, if you will. The move back to a partially invested position, we don't know how long that will be. Could be short-lived. Only a portion of our sub-indicators indicated capitulation. And again, with the economic picture being cloudy, we could reverse course quickly. And particularly if the tactical indicators reach a high-risk status, that would be our 10-week indicator and our overbought, oversold indicator, that we would be keeping an eye on for that. And we have to keep in mind that we're in the seasonally weak period of the year, and we're in the weak period in the presidential cycle as well. In particular, the period leading up to the midterm elections historically has been a weaker 6-month period of the year. So there could potentially be a sell-off from here, or at some point after the market may accelerate a little bit more, and there could be a retest of the June lows. So from a technical perspective, we're keeping an eye on our short-term tactical indicators for guidance. Another possibility certainly is that the core indicators firm up and at some point trigger a global buy. It's way too early to call that. And of course, we'll be looking at our economic model as well. And we'll give you the latest update on that in an upcoming video, so we can give you our read on any leading indications of potential recession. Again, right now it's somewhat cloudy. Well, that will do it for this week's update. Thanks for watching, and we'll see you again in 2 weeks. Have a great weekend.